This is your Monex Metals Market Update with Mike Maroney.
Good afternoon. It's Tuesday, October 6th. My name is Mike Maroney. I'm coming to you today from the Monex Precious Metals Studio. We have a very special guest today, but before we kick into Bob Wiedemer's answers on some of the questions I've put together, let's talk a little bit about where the metals were and what happened over the last week. We saw silver bottom at approximately 1430, and in the last 3 or 4 days since the jobs report announced that jobs were not growing as quickly as many people expected, and they actually went back and revised the 2 previous jobs reports, we've seen silver rally all the way from that 1430 low up to 1619 today, and we saw gold rally from the lows down around that 1115, 1120 area to an intraday high today of 1152. Are we in the midst of a short squeeze? Many people believe that could be the case, as many investors thought metals were headed lower because the Fed continues to tell us that they're going to raise interest rates, even though they seem to be putting it off each and every time they speak. But we'll get to the final end of that whole mystery this year. But before we talk about anything else, let me introduce to you Bob Wiedemer. Bob is one of the authors of Bubble Economy, written in 2006. Many people believe that may be one of the best financial books written in its era as far as predicting the financial crisis, predicting what was happening as far as the real estate markets were concerned, and predicting the financial strife that would take place as far as the stock market is concerned. Bob did come out with a new book called Aftershock, which talked about what would happen after we went through and tried to fix these financial problems. And now he's come out with a new book, Aftershock Investor. So, Bob, how are you today?
Doing great, Mike.
Great to see you. We have an opportunity once every 3 or 4 months. Bob comes in to Monex and he visits with the account reps to give them an update as far as what's happening in the market. And I want to give Bob some credit, and hopefully many of you may have seen the last video. The last time he was here, Bob predicted that there was no way that the Fed would raise rates in September. And he also predicted that the Chinese market was getting very frothy and look for that market to roll over. He felt that that could cause some financial fear, and he has something called the fear index that he believes dictates where gold could be headed. And I'm going to have Bob talk a little bit about the variables that exist within that index. Bob, could you tell our viewers today a little bit about your fear index?
Sure, and let me explain why it's relevant to gold. Is people tend to buy precious metals when they are fearful of the regular stock and bond markets. They buy more, they're worried. It might be a fundamental lack of confidence in our financial markets, in the government, on top of a declining stock and bond market. And when that happens, they tend to look for things like gold as a safe haven or insurance. So that's why I look at the fear index, and it's composed of really 4 parts. One is domestic crises, other is foreign crises. Obviously, if you have either, you're going to have higher levels of fear. Another is real estate. That's very important because people count on that real estate for their retirement. It's where most people's really good investment returns have come from. And of course, the stock market. And we look at each one, and to the extent that we see a higher level of fear, I think the pressures are for gold to go up. Right now, fear is actually relatively low in terms of domestic or foreign crises. We have one, obviously potential one, brewing in Syria. It hasn't blown up into full crises yet, but clearly with Russia involved on the ground with troops, with airstrikes, all sorts of things could happen in that area. Domestic crises, nothing yet, although coming up will be a debt ceiling issue, but that's not affecting us quite yet. On real estate, frankly, the fear is pretty low. Real estate prices are increasing in most cities, although only a few cities have actually returned to their pre a financial crisis peak. Finally, the stock market is where the fear is. There's a lot of concern over the stock market, what the Fed's doing. There's a lot of uncertainty there. Obviously, as you mentioned, China and the collapse of China's stock market, and most importantly, their economy as well, is going down, is causing a lot of fear within the stock market. And I think that's one of the reasons you're seeing more interest in silver and gold. And again, without massive money printing, I think that stock market is headed down. So I think the fear is well warranted on the market. Even if day to day we may see some ups or downs, long term without money printing, I think we're in big trouble on the stock market.
Now, last time we met, you talked about the fact that we wouldn't see a rate increase. Matter of fact, I think you predicted that we wouldn't see one in 2015, and that you felt fairly confident that before we saw the Fed raise interest rates, we might see a new round of money printing. And one of the things you showed us was a chart that gave us an idea what happened after each quantitative easing as far as the increase in value in the stock market. And it looked as if quantitative easing was the fuel that drove the stock market higher. And now that that fuel's gone, if the market's topping, maybe the Fed's going to have to come in and support it again. Is that your feeling?
Well, very much so. When I say that the market doesn't grow without printed money or will fall without printed money, that's exactly what I mean. If you look at a chart, you can see that with each round of money printing, we've seen the market go up. When that money printing stops, the market either goes down or flat, and ultimately they print money to bring it up again. We're certainly seeing that right now. Since they've stopped money printing in October, this has not been the kind of market we saw in 2013, needless to say. That market was just going straight up very nicely. This market is not, and we've had some big corrections along the way. So I think it's absolutely crucial for the market ultimately to continue a rise to print money. And more importantly, what the Fed's more worried about, and the reason I think they'll print money to help this market, is if it falls 20% or so, I think the Fed will want to step in and stop that, because it could easily go from a correction into a full-scale crash of 30, 40, 50% if the Fed doesn't jump in with a QE4.
Now, in the old days, we used to use something called growth and profits to actually increase the value of stocks. And if you look at the overall growth in the United States, just barely at 2%, according to government figures, and we're not seeing massive economic expansion. And if China's starting to slow down, that's going to affect a lot of other stocks here in the United States, because everything is tied in internationally. So if we're not seeing the economy grow, we're not seeing an increase as far as wages are concerned, the only way to really keep that stock market propped up is to continue to print money?
Yes, it is. And I think it will work this time. I mean, with all the fear and questioning you're saying, it's true. I think it'll work, but people will be nervous when you go to another round of money printing. So one reason they don't talk about it much right now. Very few people are talking about that. I've heard a few, but for the most part, people don't really want to think about it, because just what you said is it's quite the realization that, wow, money printing is the only thing keeping this market up. And that's why I think when it does happen, it will work, but it'll be a nervous bull. There'll be a lot of concern over that, because you're absolutely right. I'll put a couple of figures. You mentioned slow growth. S&P 500 revenues, negative or flat, so they're not growing at all. For one of the first times in decades, the first half of this year saw no growth in global trade. No growth in global trade for the first time in almost 25 years. So you're certainly seeing a slowing economy around the world, and that's certainly affecting our companies' earnings, and of course it should be affecting their stock prices. And that's why I think we'll need money printing. But until then, those will certainly pressure stocks for a while.
Now, one of the things that the government depends on is, one, if we experience growth, then inevitably we get higher taxation, because growth is good for taxes.
Yep, right.
And I guess 2014 was a good year as far as taxes are concerned. But if you continue to spend more than you take in, and you're dependent on money printing, the world or the population here in the United States one day will wake up and realize, and I think you use the analogy where the medicine becomes poison.
Yes, right.
Explain a little bit about that.
Yeah, and that's important, because right now there's a tremendous faith in the Fed's ability to maintain stock prices. Clearly they've done a good job since 2008 of making prices recover with their massive money printing, and people are very happy about that. And that's a faith in the Fed that could ultimately fail. And that's what we have to be worried about. Again, I think we can print money, and I think it will work one more time, But it gets a point where people say just what you're saying is it doesn't, and their faith changes. It's not just entirely that a technical, a matter of how much we print or there's a given number. It's kind of like, well, the internet bubble or housing. I mean, was there a given number where people kind of lost faith that internet companies could just keep going up, no matter what their profits were or earnings or lack of earnings? Could housing prices just keep going up, even though incomes were not going up nearly as fast? There's a point at which people start to question it, and once they question it, it's over. And with internet stocks or with housing, well, with internet stocks is not such a big deal. With housing, it was a very big deal. But if that's true with the Fed, it's a huge deal.
Now, when you look at money printing and the fact that prices go higher, how do we get out from under all of the printing that's already taken place? Is there an exit strategy in place, or inevitably we're going to see some major problems based on the cure?
Well, they actually talked about an exit strategy years ago. You notice you haven't heard much talk about it now, have you?
No.
There's really no exit strategy, because the exit strategy is very simple. It's pull that money back out. But that would have a very devastating effect on the economy. Interest rates would rise. You don't have the support for the stock market. I mean, we're only talking about with the Fed a 0.25% interest rate increase. We talk about interest rate increases, but it's meaningless. It's a minimal interest rate increase, and that's the beginning of an exit strategy. And if this 0.25% is so hard to do right now, it's very clear there's no real exit strategy from having not just doubled or tripled our money supply, but quintupled our money supply. And again, I think that'll go even further.
Now, we've seen an absolute, exponential increase in money supply. And everyone talks about, well, an increase in money supply is the purest definition of inflation. And a lot of people think, well, inflation is good for precious metals. Is the fear situation really what drives the price of precious metals? Is it faith in the system itself? And once that faith starts to wane, people look for that alternative that's somewhat outside of the box?
I think that's part of it. That's what starts that look, is that faith starts to wane. But it's ultimately, or fairly quickly, when it's backed up by a decline in stock prices or bond prices, when it's accompanied by signs of growing inflation, that fear starts to feed on itself. Because it's, as I say in the book, it's something called a rational panic. It might be a panic, but it might be rational, meaning there's a real problem there. People want to get out of traditional markets as fast as they can and move into whatever is going up, or to put the money under a mattress, which will have problems in an inflationary environment, so they're looking for something that goes up. Obviously, precious metals will be one of those things that do very well during that period. But again, at first it's kind of a fear and a loss of faith, but when that fear and loss of faith is confirmed by the numbers, so to speak, then it gets into quite a big move at that point.
So is this one of those situations where inevitably you're going to have some sort of sector rotation? Vis-a-vis, if you're not making money in real estate, you're not making money in the stock market, you're not making money in bonds, and the bonds have been in a 40-year bull market and look very toppy, inevitably that money has to rotate somewhere else. And that fear causes that rotation to take place?
The start, but the reality is not just you're not making money, you're losing money. When you start losing money, people get real worried real fast. You start losing money in stocks or bonds or real estate, yeah, people rotate out. It's called a flight to safety. They absolutely rotate out, and that's because, again, it's not just they're not making money, they're losing money, so they move pretty quick.
Now, it's interesting because a lot of people look at precious metals and think, oh, geez, they've done so poorly. But if you look at the beginning of this century, in the year 2000, and you examine the overall returns of all the different investments out there, gold and silver have done very well.
No, precious metals are crush stocks. And remember, there's not a lot of cheerleaders for gold. Certainly the brokerage firms obviously want to cheer stocks and bonds. That's what they sell. So when NASDAQ simply gets back to where it was in 2000, well, that's a huge deal. Oh my God, we're back to where we were 15 years ago. Not pointing out that silver and gold are up hundreds of percent. They're far higher than they were in 2000. So yeah, clearly people forget that and miss that. Gold is crush stocks. Of course, there are dividends to stocks, and that offsets some of that. But nonetheless, there's no question what's been the better long-term investment since we've started our first bubble pop, in a sense, with the internet bubble. It's been precious metals.
Now, I know you talk to a lot of very wealthy people, and everyone seems to be happy if inevitably we start to print more money. But haven't some of these individuals spoken to you and said, this can't continue. Aren't they deep down inside fearful of what sits out on the horizon?
I would say you almost have two groups. Obviously, you have the group that they're just happy the stock prices are up, and that's great. Then you have the fearful group, which is a much smaller percentage. Within that, you've got the guys who are really worried and think this is a huge problem, and you got the guys who are a little bit fearful but hope it's not a problem. And there may be some overlap between those and the guys who say they're happy, but they just hope this works. But a lot of people have privately or publicly in my presentations expressed a concern that I just don't see how this is going to work out, and I'm worried. They may not see exactly what I say in the Aftershock, although many of them do and would rather not, but they have a lot of concern. And in fact, even the people who might be on the happy side, I had one guy at one presentation in Florida, very, very nice man, who simply stood up and said, "You're no fun."
Yeah.
I couldn't disagree, but you could see he didn't say I was wrong either. And I think he actually hit it. I mean, he's right. He didn't say I was wrong. He didn't say that I didn't have it right. He just said it's not fun.
So people understand
They do.
deep down inside that this cannot continue on the path that we're on.
Mm-hmm.
And
They do.
is one of the problems that we're going to deal with inevitably is obviously we continue to hit the debt ceiling.
Mm-hmm.
And matter of fact, the government's kind of kicked that down the road again. Some say we can get through to December, and some say maybe November.
Mm-hmm.
And if you look at the numbers, we're going to eclipse 20 trillion in the next couple of years
Mm-hmm.
as far as debt is concerned.
Mm-hmm.
When does that become an issue?
Well, it's interesting. I'd say it becomes an issue right away, and it's one of the things that are making that group of people who are worried about how is this really going to work, 20 trillion that we have no plans or no interest in paying off, how is this really going to work? I think it bothers them. But technically, let's face it, as long as the Fed can buy those bonds with printed money and it doesn't make people worried, it could go on for a long time, 20 trillion, 25 trillion or more. Now, we've really hit, though, the end of the line in terms of borrowing, in the sense that once you have to do that money printing to make that borrowing feasible, you've kind of lit the fuse for the final bomb. So you could continue it longer. It's just that at some point, people are going to fear that the Fed has to print a lot of money to buy those bonds to enable it to continue for a while.
So the Fed, inevitably, we have to roll over a lot of short-term debt. And I'm not sure what the actual number is, but potentially it's in the trillions, I would imagine, in the course of any given year.
Yeah, about 40% would be under 10 years.
Okay, all right. So obviously maybe $1 trillion or $2 trillion a year. Then potentially we have to raise another $500 billion to $1 trillion. So if the rest of the world starts to lose faith, and if you look at the government and say they can't even get this debt ceiling right, and they start to wonder why I should be buying, if the Fed is the only one buying, doesn't things start to get dicey?
Well, they get dicey before that. I mean, ultimately, that's where you end up, is the only buyer is the Fed, and they just have to print a lot of money to do that. But that obviously will cause inflation and a lot of fear. You're sort of at the end of the line. You're like well, I don't want to use the term, but like we've seen in South America or other places, you're in trouble. But you get in trouble long before that. From an investor standpoint, long before the Fed's the only buyer, you've seen the values of stocks and bonds just collapse. So but in the end, that's kind of where you end up. But that's sort of the end game.
Is one of the things that's protected us a little bit over the last 4 or 5 years. The fact is, yes, we've seen a little bit of growth here, and so many other nations are just as bad off, if not worse, than we are. And is it because all governments are screwed up that this thing continues to move forward in this fashion?
Yeah, well, we didn't invent money printing. There are other governments who can do that. Europe, Japan, Bank of England, they can all print money. Does it help us? Well, not really in a fundamental sense. Did it help us that in the Depression lots of other governments and other economies fell? Well, ask the guys in the bread lines, they didn't think it was all that great. So if we go down just because other people go down, it doesn't really make it any better. But yes, it helps a little bit in the sense that we're given a little more credibility. You might say a little more rope to hang ourselves, a little longer credit limit, because I think we are given a bit more credibility. But in the end, Just because everybody else is making the same mistake, it's not going to prevent the pain from hitting us as well.
Now, Europe's printing, and obviously Japan has been printing. And one of the things Japan is fortunate for is the fact that a lot of their debt is internally held debt. Now, there's been rumors out there that there's 15 to 20 trillion dollars in a lot of retirement funds. Do you see somewhere down the road that the U.S. government will require a certain percentage of all retirement funds to be held in U.S. debt as a way to offset the fact that they're going to have the Fed buy if they use some of that money and force it into U.S. paper?
Well, effectively, that's what happens with inflation. In other words, when the Fed ultimately prints a lot of money, the value of those savings in the retirement accounts goes down dramatically. So inflation is sort of another form of taxation of your retirement, whether it be in a life insurance policy or retirement account, stocks, or anything. And so essentially that's what's going to happen, even if it may not happen directly, is what you're saying. Effectively, the same thing happens is the government's taking that money that's in retirement savings and, using it for inflation, essentially.
So when they monetize, it's a form of silent taxation or secret taxation?
It is, and ultimately, the value of the debt becomes less and less, but that also means the value of the debt that the people hold, and which is a lot of what's in savings accounts or retirement accounts or government bonds, becomes a whole lot less. And some people call it inflating away the debt, so to speak. But.
Now, in this type of market environment, when you look around and you say we had a financial crisis, obviously we came out with a cure for the debt problem. We created a lot more debt. And what we've seen is the stock market skyrocket in price. We've seen real estate prices come back to close to 2007, 2008 highs. Yet the price of precious metals have gone through what I like to call a correction. Some people say a butt kicking or a major sell-off. And why do you think that's happened? Is it just because people have a hard time seeing the forest through the trees, or why aren't more people looking at this situation and saying, man, precious metals look to be fairly undervalued?
Okay, well, if you are on Wall Street selling stocks and bonds, would you be all that excited about precious metals?
No.
Don't think so. So most of the investment world is run by people who sell stocks and bonds, and you can expect them to take that point of view. And also fundamentally, I don't think that people really, in a sense, want to see gold do all that well, because it does mean you've got a problem. And one of the ways we deal with problems is not so much we don't see them as much as we don't want to see them. And so rather than look at what I think is going to be one obvious way to help yourself in this situation, precious metals, they'd rather look away and say, I'd rather just think that problem doesn't exist. They hope that the Fed succeeds. They hope that something will work out. They don't know what. That's that part of the group I was telling you that they may worry about this not working out, but they hope it works out, and they're going to bet their money on it, which I think is a mistake. But
so there's a saying, I guess, the human mind will not believe what it is afraid to see. So if they look at it and say, well, the reason I want to own that is because things could get really bad, but I don't want to even think about that, so why would I own that? Right. So what we're seeing now, though, is we're seeing a market that's peaked. We don't have a lot of growth, and inevitably we'll probably see some sort of correction that induces this quantitative easing to take place. So now might be a great time to own some of the precious metals. And which ones do you like the most?
Well, I think clearly silver is poised for quite a rebound. We've already just seen that recently. But I think a lot of people are very focused on it. I think a lot of people like silver because it certainly has been repriced downward, nice way of putting it, a lot. And I think it could be a nice play, certainly during that period when there is that correction coming. Now, that said, when they print more money, you could see that people lose their fear and they're a little less interested. But it also could be offset by that fundamental unease. Why are we printing QE4? Everybody doesn't have to buy precious metals for them to go up. There's going to be a group that says, I'm getting more worried. I agree, the stock market's up. My fear levels are down a little bit too on the stock market, but my fear levels have been raised on a more fundamental level about our financial system. The fact that we have to print again worries me, and that could also be a pressure to push precious metals up.
Now, one of the things you said is international geopolitics or geopolitical situations seem to be somewhat muted. But if you look at the Syrian crisis, obviously Russia has moved in, supposedly boots on the ground. We have this immigration problem over in Europe, which it's already pretty bad over there, but then you add this variable into play, it could get a lot worse as far as borders closing and everything else. Then what do you think about this Volkswagen issue as far as Germany is concerned? Huge manufacturing company. Could this be a black swan event that nobody even saw coming? Could this cause some real problems? What do you think about it?
Well, I honestly, I think in the case of Volkswagen, I think it's a black swan event for Volkswagen stock. It certainly puts a black eye on Germany's manufacturing prowess. Might be an opportunity for the palladium platinum markets, certainly. But I'm not sure it's a black swan that's going to really take down the economy or Europe in that broader fashion. Again, I think the fundamental factors hurting Europe's manufacturing exports, again, are China and emerging market countries. They're slowing. German manufacturing exports have already slowed to near zero growth. And that's probably because emerging markets in China are slowing down. So I think that's the bigger issue. That's the bigger black swan, is thinking that the China problem is over when it's not. Syria, we'll have to see. That's one of those things that could turn out to be a much bigger issue overnight. Kind of hard to predict. It's clearly not on people's radar screen right now, but that could change dramatically.
Okay. One of the things that was brought up the other day, I was watching a financial news station, was they were talking about the massive loans that the Fed put out. And now that the dollar has increased in value so much in terms to the Brazilian currency and some of the other currencies, that the Fed can't even allow the dollar to move any higher because that could cause systemic problems. As far as the trillions of carry trade, as far as the carry loans that have been made with dollars.
Yeah, I think that is going to be an issue. The Fed can certainly control the dollar to some degree. I mean, these are traded on open markets every day. It can intervene in the markets, and it does. But that's certainly another risk. It's all part of a fragile economy that we now have to worry so much about that kind of problem. These markets, emerging markets, are fragile, and they're big, and they will affect the rest of the world. So you're right. We have an incentive not to see the dollar go too much farther and destabilize some of these other countries. But it has been a huge move. I mean, against the Turkish lira, almost 40% in the last year. So big.
Yeah, I think the Brazilian currencies dropped by 60%.
Yes.
Amazing as far as the increase in value of the dollar. Now, one of the toughest things to do, a lot of us can predict what's happening out on the horizon, but it's hard as far as timing is concerned. And obviously, we're going to deal with the Fed, and will they increase rates or will they potentially use additional quantitative easing? Timeline-wise, do you see monetary expansion, quantitative easing sometime in the next 3 to 6 months? Or do you think that that's probably a little bit further out on the horizon?
I'll take the easy way out, Mike, and I'll tell you that rather than put a time on it, I'd say, if you see the stock market decline 20% from its most recent peak, that's when I think the Fed's likely to move. Is that likely to happen in the next 3 to 6 months? Yeah, I think it is. But it's not going to be driven by the calendar. It will be driven more by the stock market's movement, in terms of how far does it go down from its recent peak. So timing is tough, but let me add something on timing I think is important. In any real investment, it's hard to time, but if it's fundamentally a good investment, it really doesn't matter. When you invest in something, if your timing's off, and assuming there's not a huge cost involved in holding this investment, as long as it's fundamentally right, that's what really matters in the end. Nobody really are going to care if you were maybe early or late or whatever. That's not what makes a good investment good. Sure, if you're flipping stock or something like that, but most true fundamental long-term good investments really depend on their long-term performance, not on the timing. It's always good to get the timing right. I'm not saying that, but fundamentally, what really matters is long-term performance.
So based on the current conditions that exist in the marketplace today, do you think gold trading at $11.50 or under and silver trading very close to $15, do you think those two investments are good long-term investments?
I think they're very good long-term investments.
And I think that's what it's all about. Bob, thank you very much. Always love to hear you speak. Enjoy your perspective, and I think the viewers do too. Well, thank you very much, everyone. I think if you're interested in hearing more about the markets, please give us a call. Or if you would like to receive a copy of Bob's book, Aftershock Investor, please give us a call so we can get your name and get one of those out to you ASAP. Thank you very much and have a great day.